I don't want to get too technical here, okay? But the LAFFER curve is the math behind this argument that excessive taxes will strangle business investment and that tax cuts will spark it. Well, my next guest thinks that there is a similar rule for interest rates. If the Fed keeps them too low, it also chips away at the incentive to invest, the exact opposite of what the Fed wants to do. Well, financier John Michaelson is co-founder and partner at Imperium, which invests in and also lends to private and public companies, which is all to say that you're seeing a lot of the markets. You know what you're talking about here. You know, John, this all came from this journal article that you wrote last week, basically saying that, look, we are in danger of possibly seeing a Japan-style lost decade if we keep rates too low, right?
Well, Betty, Japan-style, we're a very different country than Japan. We are much more robust, and Japan had other issues, but we ought to learn something from it.
Well, they kept rates too low, though, right?
They kept rates too low. And I think that you have a LAFFER curve on interest rates. The LAFFER curve had two sides to it, and one was if you have taxes too low, you collect less. Now, what I'm advocating is less popular than reducing taxes from the 70% level they were when LAFFER did the curve to raising short-term rates. And the reason is, partly, a lot of people have commented that there are all sorts of disincentives for investment in unproductive assets, but I think it goes much further with these ultra-low rates, Betty. The savers aren't earning anything, and pension funds, endowments
are not getting returned.
Not getting returned. They can't spend what they don't get, so you've got a consumption impact. Secondly, I think banks don't have to lend a productive business because they can borrow with a government guarantee at under 1, lend it back to government guaranteed entities at 4, pay themselves big bonuses.
So basically, I want to simplify that. So basically what the banks are doing is that, you know, they can get cheap money at basically nearly 0% interest rate, and they just make the difference by investing it back into the treasury markets and getting like 3 or 4% yield, right? So why do they need to then lend that money out? And
that's right, and lending has risk and concern. And finally, I think there's a confidence issue. What Howard Dickman at the Journal calls the 401k generation, that's my generation, isn't earning on their retirements and is not going to spend and is worried.
But are you of the view, as Honig is, who some have said, oh, he's gone off the reservation with this whole, you know, raise interest rates, but are you of the view that we should raise interest rates to 1% and stay there for a while?
We don't know nobody's studied this actually, because the total consensus in economists is low is good, lower is better. So nobody's really studied, is there a point where too low is bad? But yes, I think raising short-term rates would have two great impacts. Savers would get money, they would get more confidence, and banks would have to go out and find loans that are more productive.
Okay, all right, John, we'll have to leave it there, but an interesting argument there, and you know, certainly different because a lot of people have been talking about keeping rates this low, including the Fed.
Yes.
John Michaelson of Imperium Partners, thanks so much for joining us.